Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we're back from our last week's hiatus when I was in Texas. We spoke at a conference, which I think went very well. If you'd like the presentation from it, just let me know, and I'd be happy to email you the PDF. But some of the things that we want to talk about today, because there's a lot to discuss in the Econ Show, and we'll try to go a bit faster because there are a lot of slides, and unfortunately, a hot mic and me tend to be a little too friendly, and I can go for a while. So the 5 segments that we're going to cover is we're going to look at the global economy and some of the cracks that we're seeing. So there's 2 different pieces to this. One, there's the cracks that are showing up on the leading indicators, and we are seeing some strength in the near term, but we want to look at, well, is it strength because they're positive contributors to the data? Are they negative? Because remember, as supply disruptions increase, that actually pushes PMI higher. So it's like, even though that's a negative to the underlying piece. So we want to look at what are central banks doing, and then we're going to provide an update on Russia-Ukraine, because there are some important shifts that are happening there. Then we're going to look at in the US where the leading indicators softening in a big way. But we did have some recent strength, and we're going to talk about service PMI. Some things kind of holding in a bit, but are they going to continue to hold in, or are we going to start to see that crack? And then we're going to also mix into both segments 2 and 3. In 3, we're going to go deeper into jobs, personal spending, and housing, because real estate is obviously a big piece of where things are as the mortgage rates continue to rise. And then in Europe, we're going to show how March data held up fairly well given what expectations were, but what is happening going forward given where we are on just the cycle of wages and the consumer inflation. And then we're going to talk about how just Chinese data just took an absolute nosedive when we look at lockdowns and things that happened within that country over the last few weeks. So here, before we kick off, now that we're going to talk about what is happening in the global market, we want to look at balance sheets, because the cumulative central bank balance sheet, you get an idea since obviously 1999 where balance sheets sit today and how we're at about $27 trillion. And when you look at from the beginning of COVID to now, we've added about $12 trillion, $11 trillion to the balance sheets. So how much of that is going to come off, if any, as we start to see some of the shrinking and tightening? And this is just looking at, 5 of the largest central banks, obviously the Swiss, Bank of England, Bank of Japan, Federal Reserve, and the ECB, to understand, okay, well, as we now see tightening, who is tightening? Is it just going, and this is where it becomes very important. I had a great question asked on the last Thursday of, well, what would you do if you were in the Fed? Like, what do you think the Fed is going to do? And one of the things that they've already started this is they will raise rates. That's a no-brainer at this point. But I think they're going to be hesitant to sell off the balance sheet. They will let things expire, but I don't think they're going to be all too excited or in a rush to sell down. Now, the Fed chairman, the Fed governors are saying a bit different. They're saying that they're going to have to, and they could just because they see so much risk. But this is going to be kind of the balance of how dovish are they versus hawkish. I think a 50 basis point increase is essentially priced in, but it's what's going to happen with what's on the balance sheet. And that's the biggest question right now. I do think rates go up, as we've been saying. I do think the 10-year goes to 3%, and that's going to put even more pressure on emerging markets, which had a weird bid last week, but now they're coming back down. And I think some of the big pressures at this point as well is on the 30-year. And when you look at mortgage rates, which are now actually back over 5%, but we'll talk about that in segments 2 and 3. So global monetary stimulus, I think this is obviously a very important chart. When you look at where central banks, the last move was a rate cut, was 8-month lead time. When you look at the actual cuts is, we have central banks raising. So we actually have, obviously there are no rate cuts. We are in a net tightening cycle. And this just kind of shows you where global manufacturing PMI ends up when you're in a tightening cycle, which is obviously things slow down, which is why we keep talking about. And now the question will be, how fast does it go down? Because the question is always, are we in a recession? Are we going into a recession? And then you'll have me included, a finger to the wind of, it's going to happen in Q3 and here's why. No one really knows. I think that Europe is in a recession right now. I think the U.S. is getting close, not there yet. I think emerging markets are. But again, a economic recession is defined as 2 consecutive quarters of negative growth. Is it Q2? Is it Q3? Is it Q4? I can safely say the U.S. is going to bump along the bottom. Whether they dip negative or stay slightly positive is going to be kind of this weighted more than that. And I do think we get into one. I think it is Q3 of this year when it starts. But again, we'll go through that as we get new data points, and you'll be along for the ride, I hope. So when you look at global trade, it had gotten back on track to hit new records, and I think this is important because when you look at the merchandise trade, we have seen some of this come back. So despite declines in trade volumes for China and emerging economies in January, overall global trade volumes hit a record level and advanced economies had strong gains. But you have to think about the supply chain disruptions. There was so much backlog, and now that it's starting to show up, this is kind of that last push where finally it's like, and we'll have the ISM data, the PMI data to show how the supply chains improved a bit, and inventories are, I'm not going to say back to normal because they're not, depending on where we're talking, but inventories normalized a bit. So you're starting to see again some of this backlog, some of this normalization, and you're starting to see again this balancing. But it doesn't mean that things are back to normal. It just means that we're starting to see some of that. But as consumers slow, as activity slows, that's again going to keep a lot of that in storage, in inventory, which is why we don't think that trade is going to continue to go up, but kind of just go sideways, come down a bit, but again, bump along the bottom. And here's, I think, an interesting chart because everybody likes to talk about the death of the dollar. So discussions keep picking up about the China's renminbi acting as a possible replacement for the US dollar in terms of global currency reserves. But just look at what would have to be replaced. So just look at the dollar, which is about 60%, euros, which is another 20%. And yes, yen is making some headway. The Chinese renminbi is just starting to awaken. I mean, if this chart doesn't speak for itself, I'd be happy to do a much bigger deep dive on it, just because I think that there is a bigger problem and something that needs to be looked at. Now, not to say that the dollar is going to become, it's just euro and the dollar are so entrenched in global trade, in debt, in the way debt is issued and how it's paid. It's really difficult to see this being adjusted any time in the near future, which is why, again, we've said it before. You can go into our YouTube channel. We have a show called the USD Dynamics, and I think this chart kind of proves out again what we were saying, where the dollar's going nowhere anytime soon, and here's why. Now, when we start looking at leading indicators, world manufacturing PMI came down again. We had some more weakness. You can see that month over month on a world level, it fell another about 1.25 points. And you can see emerging markets getting worse, down almost 2%. Europe, Middle East, Africa, down almost 2 points. These are the problems that we continue to see. And this was issued even before China came out. So again, it's not negative. And that's what I keep trying to point to. We're still growing. Anything above 50, you're expanding. We're still growing. We're not there yet on this, massive global recession, depression, whatever. It's just, where are we going to be? And that's what we see more slowdown. We see more pressure, but it doesn't mean we go negative. And that's the biggest conundrum, because everyone's like, oh, well, what is your timing of this? What is your duration? And that's where the caveats, unfortunately, are real. Because when I keep saying that there are cracks forming, there's slowdowns, it's still not fully negative yet. And that's where we want to look at, well, when does it go negative? And so far, we're trending down there. There's more pressure to the downside. We do think the next print is much closer to 51 after being at 53.6, because input prices continue to surge, more demand destruction. So again, there's that move, but you can see how steady it was as we were in 19. Because remember, 2019, we were bearish. We started to get bearish. 2019 summer of 19 was fall of 19. And here's why. You had this kind of decelerating move. And that's what we see right now, is we're seeing something very similar to these slowdowns. The problem is in 19, you did have some tightening on the quantitative side, when you're looking at monetary policy, but we're seeing that in spades, plus financial tightening, plus the financial drag. Again, these are things that are going to make it worse, which is why when you start looking at global negative yield, we're continuing to fall. Now we're right back to where we were in 2015 as the yield continues to get positive, as inflation continues to bite, and all these other issues remain on the global market. Now, this was, I thought, an interesting chart when you look at OECD house price ratios to total price to income. House price to income ratio aggregate measure per OECD has surged to the highest since mid-1970s. To give you an idea of just how absurd prices are for housing and this is in relation to where wages are, where wages just have nowhere even been close to keeping pace. How price to income ratios, just going back to 1975, and then OECD house to price to rent ratio is even more absurd, as rents have also surged as wages. Again, all of these things just impact the ability for people to spend money. And I can't stress that enough, because these are developed markets where people are supposed to have more discretionary income, and this theme is going to continue to rise as we progress through the segments 2 and 3. Now, you're going to see that there's going to be a progression of 3 slides. And the reason why, instead of just having one, I wanted to show the advances that the Ukrainians have made, because I think it's important to look at how things have shifted. So the recovery and territory in northern Ukraine following Russia's withdrawal from these areas is revealing large-scale atrocities, as we've seen, I'm sure, on social media, in the news. But right now, there's been a lot of counterattacks from the Ukrainians. They've been able to successfully essentially push the Russians back into Belarus. But based on most recent intelligence, we're seeing that they're getting outfitted, re-outfitted, reorganizing to make that additional push. So it doesn't mean that anything is over. It was a tactical retreat as much as it was, Ukrainians were definitely on their heels, making sure that they didn't have second thoughts and turn around. We have seen some adjustments on the from the northeast, again, with the Ukrainians pushing back, regaining some of that land. They've managed to secure the territories as well. So again, they're going to be able to put up additional capacity. Ukrainian forces continue to clear individual locales behind the rapidly withdrawing Russian forces, again, continuing. And then following the capture of the eastern bank of Izium, Russian troops have managed to proceed towards the southwest. So even though there's a lot of adjustments in the north and the northeast, the Russians have been gaining some additional ground when you look at Donetsk and a lot of these areas. But Ukrainian troops have maintained pressure around Odessa. And when you look at essentially anything north of Crimea, along most of the eastern Ukrainian front, Russian forces continue to mount attempts to break through defense lines, but have not managed progress in Mariupol as well as Donetsk and the other areas. So the only place that we've seen a significant amount of Russian progress, if you will, and it's not even as that much significant, is on that eastern front, on that east to west push when you look at coming across. So now that we look at where that is, well, let's look at how things have adjusted further. So you can see that there's been a complete withdrawal for the most part when you look at the Northeast. And that's why, again, I wanted to show the progress where there's been that pushback. It doesn't mean that Russia isn't going to push back in. It just means that they're regrouping. And I think that's going to be an important piece as the Ukrainians look to dig in and try to solidify the region. Now, that when you look at where things are coming so far, they've reestablished control over the borders in Chernov region as they withdraw. Russia's completing its withdrawal from the Sumy region as well. The question now is, do they re-engage and push forward, or do they cycle back and essentially make a hard push to go to the river that cuts through down into the Crimea region and look to try to take more of this to Dnipro, which has been kind of that bigger push. As you can see, the Russian forces are still trying to force an advance south of Izium in an effort to envelop Ukrainian defenses in North Donetsk. And remember, this is where they've had a lot of infighting. This is where the from essentially 2014, this is where the Ukrainian military has really been digging in and creating defenses, which is why they've been so hardened with the ability to repel a lot of these attacks coming in through the Donetsk regions. So that's going to be an important piece to watch as we continue to look at what is happening. Russian combat operations also continue at the city of Mariupol. Hat tip to the Ukrainians in that area. I mean, talk about withstanding pretty much a massive siege and doing it effectively and really creating a significant amount of losses for Russia. There was a surrender as pressure mounts, but again, that's something that is continuing to be a sore spot, if you will, for Russia. Now, when you start looking at some of the different shifts, so just taking away the Northeast, because as we were the Northeast, as we've been talking about, that has been solidified. Russian troops managed to extend several kilometers south of Izium in previous days, but further advances have been halted. And there's been a lot of counterattacks, and they're using the Ukrainians are using very similar tactics that they use in the Northeast to try to essentially allow the Russians to make progress and then cut into the back and have a lot of attacks on supply lines, trying to hit the rear flank and really trying to impact, which they've done successfully and so far continued to do successfully. And then when you look at Ukrainian forces continue to push Russian forces south from the direction of the Kiev while simultaneously attempting advances toward Kherson. So again, we're seeing these pushes down. Now, I think it's important when you look at where this is happening, because a lot of this is going to be in Donetsk. So Russian forces keep trying to fight their way into the towns of Severodonetsk and the adjacent Rubizin, but the advances to the south present a much greater potential risk to Ukrainian control, because then they would be enveloped. So again, we're watching all of these different pieces, and this is where right now we've had a pause with Russian-Ukrainian peace talks. But more and more pressure is being mounted when you look at, well, where are some of these next deals going to come into? And Russia has appointed a new leader of the Ukrainian war and the war effort and invasion. So this could just be, again, that regrouping. The Donbass continues to intensify, which is continuing to be, I think, the biggest focal point when you look at Luhansk and Donetsk. So again, these are going to be those key pieces. But as this is happening, you have to think about, well, what is the impact to the Russian economy? And Russian manufacturing PMI, obviously not surprising, getting absolutely walloped. Russia services was expected at 46, came in at 38.1. Supplier delivery times, it's worse than COVID. Again, there is a lot of pain within the Russian economy. And right now, I think Russia has successfully helped convince people that this is the West's fault, that we are the main reasons for this. And again, there's when you can control the narrative, there's a lot of power, and they've been doing so, I think, fairly successfully internally. Which again, all of this pain is real, but who they're blaming for it is very pronounced and obviously anti-West. And now there's a 99% certainty of a default, which again is going to increase their issues. Russia manufacturing PMI output, again, nosediving. Russia manufacturing PMI input prices, record highs, which just means that inflation is just getting started and only going to get worse when you start looking at what is happening in Russia. Again, fertilizer flows continuing to be disrupted. They're continuing to withhold some of these underlying flows, which again is creating a lot of these underlying problems. The global manufacturing PMI continues to weaken, as we talked about previously, and it's when you just take what's happening in Russia, what their involvement is in the rest of the region, and the problems that are going to continue to happen between Ukraine and Russian entities, and what does that mean not only for manufacturing, but also what does that mean for grains and fertilizers, which we're going to discuss in a moment. So now when you look at that world trade, this is just giving you an idea of that last kind of spike. Now this is as we look into where things are going, because this is February, we do see some slowdowns in March. We did see new export orders dip, new orders dip. And again, that's that leading indicator for where we see some additional pressure. Logistic managers, supply chain inventories are sitting at a record high, not a low, and the supply chain, again, is moving fast, but we're starting to see some of this come back as the LMI, or the Logistic Managers Index, has been flashing warning signals. So again, even though we saw this big surge in trade or in movements, we're now seeing the opposite and things actually slowing down, putting some of those additional pressures. So ships waiting to load or discharge at Shanghai, as you can see, is at a record, and it's because of the lockdowns, and we don't see that adjusting in the next week or two. So this is also going to create more supply delivery issues, but there's higher inventories. So some of this maybe will be weathered a bit better, but again, just leading to more pressure. So world delivery times, they had improved, and when you zoom out, because again, it's important, but they've worsened again a bit. Still not as bad as they were, but still a big problem. Not surprising, Russia has the worst, and we don't see that changing based on what we've said previously. China, Eurozone, again, longer and getting worse, which is why we do think that there is more pressure in Europe than the US at this point in time. We do think that Europe is in a recession right now, as March started out slow and things only got worse in April. So, but Q1 will be growth, so it's not like we're going to see a recession today. It's just they're seeing negative growth at this point in time. The U.S. has shortened, but again, it's going to get a bit worse, and the world delivery times are going to continue to be a problem. When you look at global shipping rates, they remain lofty, but have come down a bit. Again, they're just going to stay here at this point in time and just kind of bump sideways as we get some of these competing factors. Rising food prices lead to more political instability. Gee, I can't think of anybody that's been saying that. So again, I laugh. I shouldn't, because it's true, and it's only going to continue to get worse as the World Bank food prices continue to move to all-time highs. And again, it's going to increase the pressure in the world. I thought this was a really good chart because it shows the Ukrainian crop cycle, and it just shows how essentially we've missed barley. We're going to miss corn and wheat. It depends on, do we have peace? Do we have anything, which is highly unlikely at this point in time? So it just gives you an idea that, as the war progresses, as things continue to be a problem, you can continue to count out many of these grains, many of these cereals, which is just going to leave a bigger and bigger glut within the global market. And the U.S. is also seeing as pressure leading to some of this. So charting the trend, people experiencing food insecurity. One of the things that we've been saying, and if you look at 2019, you can see that it started to go higher. And that's what I keep stressing is, food shortages, food insecurity does not happen overnight. It's not because oil prices surge. It's not because, Russia instantly moved into Ukraine. It takes time. And look at 2020. It increased in 2020. Russia had not invaded Ukraine yet. When you look at this, it's slowly and then all at once. And that's what we're seeing right now. And we continue to see pressure around the world on yield and grains. U.S. winter wheat conditions, -22. This is the worst number ever since we've been collecting this data in the U.S. So we know Latin America is in trouble because of drought and lack of water. We know that Eastern Europe is in trouble because of Russia, Ukraine. We know that Africa is in trouble because of drought. We know that China is actually getting a little bit better in terms of their yield. But we export our excess. The U.S. exports excess. We feed ourselves and then we export the rest. If this stuff continues, we will have less excess to export, creating, again, a bigger global problem. U.S. ending stocks, just giving you an idea, corn was at 1.41. The expectation was for 1.44. Soybeans was expected at 2.8, came in at 2.6. And then wheat was expected to. So again, kind of leading to additional tightness, additional problems, everything that we've been saying. But the other issue is water stress continues in the region. And if you look at just where the problems are, a lot of that is in Nebraska, Wyoming, parts of Iowa, South Dakota. A lot of areas that we rely on for our food is struggling on just water stress. It's not to say that we can't get it there, we can't use watering, but again, these are the problems that are going to keep cost elevated and keep yields low, because when you plant a seed and the seed sees that there's a reduced water moisture in the soil, it naturally shrinks itself, again, in decreasing the yield, which is going to put more pressure on grocery expenditures, which are already over 8% on average. When you look at most of the U.S., it's either 6% or more of disposable personal income. So as that continues to rise, that's where you're going to see people spending less, fear coming through, people concerned about where the next step goes. And here's just looking at the gas price, which is just a big piece of it, but not the only piece. But the two of these together, again, create a lot of the problems and the fears that we see, reducing underlying spending. And then when you look at fertilizer prices, which this has a lot of impact from the energy price, but when you look at energy prices, so look at 2008, crude was $154. Right now Brent is $101.50. But look at fertilizer prices. Where's natural gas? Natural gas prices, like all of these things. But we also have a big pull, trying to replace yield, trying to repair soil, creating a lot of these underlying problems. And that's why when we look at the ag economy barometer in the U.S., you're seeing that even though things should be going very well, they're struggling right now because of the underlying problems that we're seeing in terms of just price and input cost. Farm capital investment, again, that under pressure. It's been here before. It's not that people aren't going to plant. It's just you look at the numbers and you think, oh, these guys should be minting money, but there's input costs, and that's what's going to keep those prices elevated because farmers have to protect their price. So then when you look at top steel exporters, the combination of Russia and Ukraine would create the world's second largest steel exporter with 43.8 million metric tons. So when you think about exporting, when you think about these movements, this is where you continue to have these problems. But where is steel important? So when you think about green energy and you think about where steel is consumed, electrical networks, hydrogen, wind power, solar, EVs, steel pricing is you can't escape it, and that's going to continue to keep inflation elevated, going to continue to keep prices high. And again, this is going to be the underlying problem when you look at supply chains. We've talked about coal, we've talked about copper and tin and food. This is a key one that is not going away anytime soon. Now, in the next segment, we're going to talk a bit more focused on the U.S. and kind of where things sit and what do we see happening over the next few quarters.